Welcome to The Explainer. Today, we're pulling back the curtain on the invisible mechanics of the 2026 crypto market. We're going to dive deep beneath the surface and explore exactly what's going on behind the scenes, from the psychological traps draining retail accounts to the high-level math institutions are running, all the way up to the massive global forces colliding right now. So let's jump right in. Take a look at this number, 70 to 90%. That is consistently how many retail traders lose money over any meaningful time period. It doesn't matter what the specific asset is or if the market cycle shifts, this brutal underlying reality practically never changes. It is a constant in the market. So you've got to ask yourself, is it simply a lack of knowledge? Our immediate assumption is usually, well, if I just study more charts, if I take another course, or find that one magical technical indicator everyone else missed, I'll beat the odds, right? But is that true? The data actually suggests otherwise. Because as traders gain knowledge, their win rates don't really improve the way you'd expect.
Actually, scratch that assumption. The real culprit is structure and psychology, specifically how we size our positions. Look at this stark divide. On the left, we've got emotional sizing. Human instinct essentially forces us to build an inverted portfolio. Think about it. When a trade goes against us, we average down. We throw more capital at a losing trade, desperately hoping for a balance. But when we're winning, we get nervous and cut it short to lock in a tiny profit. Compare that to mathematical sizing on the right. This is process-driven and risk-adjusted. It's the exact opposite of what your gut tells you to do.
So the crucial point is this. Even if you completely eliminated every single emotional error, trading starts out as a negative-sum game. Every time you execute a trade, you're fighting structural market frictions. We're talking exchange fees, bid-ask spreads, and market slippage. That friction doesn't magically disappear just because you made a smart trade. It just compounds over time, silently eating away at your capital. Section 1. Trading the charts. Human bias versus machine scale. If you spend any time at all looking at charts, you know the drill with support and resistance. Support is a price floor where buying pressure kicks in. It's like a safety net. Resistance is the price ceiling where selling pressure takes over. These are absolutely crucial psychological zones that show us where liquidity is concentrated. But while the concept itself is totally sound, the way most of us interact with these levels is structurally flawed. This comparison perfectly highlights why retail traders get left behind. Most people are drawing these trend lines manually. You can really only monitor a few charts at a time, the lines you draw are highly subjective, and honestly, it takes hours. Meanwhile, institutional-grade automated tools, like the ones on platforms such as AltFins, are instantly scanning over 2,000 coins at once. They are purely data-driven, objective, and lightning fast. You're basically bringing a manual pencil to an automated machine gun fight.
Section 2. The tokenomics trap. Engineered scarcity.
Now, what's really interesting about this slide is how modern tokenomics are explicitly designed to trick your perception of value. For years, the ultimate growth hack was launching a token with a super tight initial float. A project goes live with only 6% of its supply actually circulating, while a massive 94% is locked up for insiders and early backers. Because of that engineered scarcity, it takes very little actual capital to push the price up, making the chart look incredibly strong on day one. But here is the devastating consequence of that artificial scarcity: $155 billion. Let that sink in. According to Binance research, that is the staggering value of the token unlock overhang waiting to flood the market by 2030. That is an invisible ceiling of pure sell pressure, systematically designed to dilute the retail buyers who thought they were getting in early. Veteran market observer Kobe hit the nail on the head when he said the private capture of upside happened in an inaccessible way. Everyday participants are just exhausted. They've realized they're basically functioning as exit liquidity for these relentless insider emissions. And without blind retail demand to absorb those scheduled unlocks, these heavily inflated token models are practically guaranteed to collapse. But hey, not everything in this space is built on pure speculation and tokenomics traps. Real utility bypasses market friction entirely. Take platforms like Tokes, or TKS, for example. They focus on actual business integration. By utilizing a decentralized ledger for supply chain visibility and point-of-sale systems, their transaction costs drop to less than a cent. That completely strips away the standard 2 to 3% interchange fees traditional credit card networks charge merchants. When a token operates as an actual tool rather than just a speculative asset, it doesn't need to rely on engineered scarcity. It just generates real value.
Section 3.
Modeling the chaos. Institutional math.
So, how do big institutions actually measure and model this chaotic ecosystem? Well, they definitely aren't just drawing lines on a screen. They rely on advanced quantitative math. Enter GARCH modeling. Yes, it stands for Generalized Autoaggressive Conditional Heteroscedasticity, which is a huge mouthful, but the concept itself is incredibly powerful. GARCH is essentially the mathematical lens smart money uses to quantify extreme fluctuations. Instead of just guessing if things will get volatile, they use it to measure dynamic volatility patterns and figure out exactly how sensitive an asset like Bitcoin is to a sudden market shock.
And once they measure that volatility, they forecast it using Monte Carlo simulations. Look at this timeline. They don't just predict one single future. In month 1, they establish correlations with traditional assets like the S&P 500. By month 6, they are simulating thousands of random market shocks. And by month 12, they've mapped out the exact probability distribution of price trajectories over a full year. They aren't predicting the future, they are calculating the probabilities of risk.
Let's move to section 4 and see how this builds into our final grandest scale, the 2026 market clash, global macroeconomics.
Ultimately, all that institutional modeling collides with global macroeconomics. And right now, the landscape is a monumental tug of war. We've got two incredibly powerful competing narratives driving the market. The bear case, fueled by systemic risks, and the bull case, driven by liquidity and structural adoption. Let's impartially examine both sides of this ledger.
Let's look at the 2026 bear case first. We're seeing heavy sell-side pressure and broad risk aversion threatening stability. In traditional equities, analysts are closely monitoring an AI infrastructure bubble overhang. In crypto, we saw the massive 1010 crash triggered by sudden tariff escalation threats from the White House. On-chain, old Satoshi-era wallets and long-term holders have been steadily distributing their supply. Throw in periods of sharply negative U.S. spot ETF flows, and the ultimate macro warning sign, Warren Buffett's Berkshire Hathaway sitting on a record $381.7 billion pile of cash. That is a signal of extreme caution regarding global risk assets.
But we absolutely have to balance the scales with the 2026 bull case, which highlights massive dry powder and major policy tailwinds waiting to deploy. Central banks in the US and the EU are cutting interest rates, injecting liquidity into the system. Despite some short-term outflows, spot Bitcoin ETFs have seen a staggering $30.2 billion in year-to-date inflows. On the policy front, President Trump signed a major bipartisan stablecoin law. There is a massive $307 billion stablecoin liquidity float just sitting on the sidelines, ready to move. Plus, we recently saw a major de-escalation in US-China tariffs, clearing a significant roadblock for global trade.
So, taking all of this in, from the behavioral flaws of retail sizing to the engineered traps of token unlocks, right up to the massive clash of global macroeconomic forces, I want to leave you with one final crucial question. How do you fit into this complex machinery? Are you going to keep relying on emotional guessing to navigate a system that's designed to exploit you? Or are you finally ready to trade the guesswork for a structural, mathematical process? The market is moving, and it certainly won't wait for your answer.